So one of the first ever stock analysis videos that I did on this channel was on Lightspeed Commerce. This was the first video where I really introduced my investing process to you guys, and still to this day is actually one of the most viewed videos on this channel. And what I tried to do in that video is what I try to do in most of the videos I do, which is determine how well a company needs to perform for you to conclude that you'll earn a decent return on your investment if you invest in them, and then assess whether or not that future performance is actually reasonable. And in that video, I concluded that the price for Lightspeed was too high and that it seemed like there's too much optimism already priced in. And when I made that video, they were about a $105 stock, because I made the video in late June of 2021. So it was about here, or about $105 stock. And then in the subsequent months, we can see that they shot up to almost $150 per share in Canadian dollars. So a pretty significant rise, and not much really changed materially in the business. It really just went up on a lot of momentum, as was common with a lot of growth tech stocks during that time period. And around that time, I was getting tons of comments on that video saying I didn't understand the company and that people shouldn't have listened to me in the video. But then, as you could see in the subsequent months, it fell, and it fell by a lot. Now, for those who aren't in the loop, this significant drop in share price was driven by a short seller report that got released by a famous short seller called Spruce Point Capital Management. They've done this type of thing a few times, specifically targeting Canadian companies. And just a few months later, they did the exact same thing with Nuvei. And you can see Nuvei, which is another video that I covered really earlier on in this channel. I believe it was like the third stock analysis video I made. And they had a significant drop as well. Now, they have actually recovered quite a bit from there. I believe they're up close to 20% in the past week, which you can't really say the same thing with Nuvei, because with Lightspeed rather, as soon as that report got released, they just keep going down and down and down. And they had a bit of a recovery here, but then in the days following, they've even dropped more than the initial drop that happened once that report got released. Now, here's the actual short seller report that Spruce Point released for Nuvei specifically. And we can see a lot of the things they're pointing out aren't to do with material changes to the business. It's mainly the fact that some of the executives are a little shady, which, I mean, is nothing new. There's lots of companies around the world that are run by shady people. And there are a few things that they point out that would suggest that maybe Nuvei is not growing as much as they led us to believe, us being the investors. But if we compare this to the Lightspeed one, a lot of the points they're bringing up here are related to the actual growth of the business. And that's why everyone's investing in Lightspeed. Their whole stock price was inflated to what it was because people believed in the growth story. So when something comes out like this that convinces people otherwise, people start to lose confidence in the business. And of course, you can see fear sets in, panic sets in, and people start selling off the stock. So they point out that a lot of the acquisitions they made were seeming stagnant businesses or even declining businesses, and that they seemingly inflated some of their key metrics, such as average revenue per user. Now, something I also said in the Lightspeed video was if the shares drop, then maybe I'd consider adding a position. So now that the shares have dropped by a lot, I figured I'd explain why I'm still actually avoiding this company and not even thinking about opening a position. So my fundamental belief in investing is that the price of a company, meaning the market cap, what the market thinks the company's worth, and the actual intrinsic value of a company are different. They're completely independent of one another. And the job of the investor is to identify large discrepancies between price and value, because that makes for potential buying and selling opportunities. However, there's one aspect where this is not entirely true, and that's when it comes to raising capital, because companies that have high share prices can raise capital at high prices, which can alter the business really, because they could use that money to aggressively grow the business, which leads to better metrics, and then the better metrics lead to higher share prices because the sales appear to be higher and it seems that their growth story is working. So the success of the business does kind of boil down to not only growing fast, but convincing investors that you have a viable business model that will eventually become successful. Even if you're taking some pretty large losses right now, you're not actually free cash flow positive yet. It's all about instilling that level of confidence in the investor. And Lightspeed's strategy involved going out there, making tons of acquisitions, and they need a high stock price to do that, because how they were making those acquisitions was by issuing shares. The more money that they're able to raise to make these acquisitions, the better it is for the business, because it means they can show higher revenue growth without having to issue as much shares as they would after they had a lower stock price. But now that level of investor confidence that was there only a few months ago is not there anymore, or at least it's not what it once was back a few months ago. So now, if Lightspeed wants to make an acquisition or, say, raise financing to fund some of their losses that they're incurring before they become profitable, they're going to have to issue a lot more shares than they previously need to, which means more dilution to you as a part owner of the business. So their whole growth strategy really has been compromised just by the fact that their share price has declined as quickly as it has. Now, granted, they are currently sitting on a rather large cash pile. This is their quarterly balance sheet here, and we can see as of their most recent quarter, which was September 30th, they had about $1.2 billion in cash on hand, which would be impressive, except for the fact that the only reason they have that much cash on hand is because they issued a ton of shares to get it. If we go over to the cash flow statement, and then we just scroll down and take a look at the issuance of common stock, which is in the cash from financing section, we can see they issued $832 million in shares in this quarter here. And then if we take a look at what their share count has actually been like, we can see that just over a year ago, so September 30th of 2020, they had about 95 million shares outstanding. And then we fast forward to their most recent quarter, they have about 139 million shares outstanding. So that is pretty significant dilution there, meaning if you own this business in September of 2020, you now own just under 50% less of the company than you did just 1 year ago. So even if their revenue is up close to 200% year over year, and it seems like it's growing fast, if they diluted you by 50%, then your actual benefit as a shareholder is much less than 200% year over year growth. It'd be closer to 150%. So this dilution has kind of already happened. But what this means is that the pressure is on them to start growing organically. They can't just grow by making acquisitions and further diluting shareholders. They have to actually show that the acquisitions they have made are going to create synergies and actually be more valuable to the business overall and generate more shareholder value. So now going back to the Spruce Point report, one thing they pointed out was this lack of organic growth in both the core Lightspeed business and the businesses that they recently acquired. And specifically, they pointed out the lack of organic growth in their recent larger acquisitions after they made the acquisition. So Shopkeep, Upserve, and Vend were all pretty significant recent acquisitions for them. And they also pointed out how these businesses were seeming to inflate their customer counts. And a lot of the metrics that Lightspeed was reporting weren't really adding up after having incorporated those businesses that had worse metrics. They would say Lightspeed would report the exact same average revenue per user, but then they would add one of these new businesses that has a lower average revenue per user, and Lightspeed's reported metric wouldn't change, which doesn't really make sense. And then they also pointed out how the golf segment as a whole is kind of in a decline phase here in Canada. And that's one of the key markets that Lightspeed likes to sell to, or verticals as they call it, is the golf market, part of the whole hospitality industry. So even though their share price has gone down close to 50% in the past few months, they're still valued at about 6.5 billion USD with less than 400 million USD in sales. And yes, sales are growing, but also consider they're not yet making a profit. They're not yet free cash flow positive. That's still a rich valuation that has a ton of future growth priced in. So it's not like even despite this recent drop, Lightspeed is a value type of investment. They still need to grow aggressively for you to earn a decent return on this type of company. And something that will dictate that return is the success of these acquisitions they've made. Because when a public company makes an acquisition, usually they're going to have to overpay a bit, meaning pay more than the business they acquired is intrinsically worth to secure the acquisition and actually close the deal. And that's because when you combine companies, you realize synergies, which are cost efficiencies from streamlining operations, revenue increases by potentially cross-selling services, all kinds of stuff that make the combined entity more profitable and therefore worth paying a premium for. So the present value of those synergies, so kind of extra cash flows that the business realizes by combining these two companies, needs to be greater than the premium paid to acquire the business for the acquisition to actually add shareholder value and therefore be beneficial to you as a shareholder of the company. And this is why a few months ago, when it was announced that Canadian Pacific Railway would be buying Kansas City Southern Railway, this is a huge deal that closed not too long ago, their stock dropped like 5% in one day when that got announced. And it's because investors didn't believe that the synergies that would be realized between combining those two companies would compensate for the premium that they would have to pay to actually acquire Kansas City Southern. So they were predicting that it would destroy shareholder value in the long term. So now tying all of this back to Lightspeed, we know that they just made many acquisitions. And if they can't realize any synergies from those acquisitions, they won't help to make the business more valuable. And as was pointed out in the Spruce Point report, there were several of them that were stagnant businesses, or some of them even declining businesses. And the disclosures that Lightspeed was making about certain revenue metrics just didn't seem to add up, and they seemed rather illogical. Not to mention how many shares were issued to actually acquire those businesses. So to me, it doesn't seem like there's a lot of reason to be confident in Lightspeed, and that management is really more concerned with convincing you of their growth story rather than actually growing the business itself. And even when I did my initial analysis video on Lightspeed earlier on in this channel, one thing I pointed out was the lack of organic growth and how most of their revenue and customer growth was coming from just adding new businesses and making acquisitions, and not actually an organic increase in demand for their platform, which is different from a company like Shopify, which a lot of people are comparing Lightspeed to. Shopify was growing organically and growing very fast organically, which just doesn't seem to be the case with Lightspeed. So tying this all back to Lightspeed now, we know they just made a ton of acquisitions. So if they can't realize any synergies from those acquisitions, they won't help to make the business more valuable as a whole. And what was pointed out in the Spruce Point report was that several of these businesses were stagnant businesses, or even possibly declining businesses, which isn't good. And also the revenue disclosures that Lightspeed was making about their acquisitions, it just didn't really seem to add up. A lot of the metrics just didn't really make sense anymore. Not to mention how many shares were actually issued to acquire those businesses in the first place. So to me, it doesn't seem like there's a lot of reason to be confident in Lightspeed, in that really management is more concerned with convincing you of the growth story of their business rather than actually growing the business itself. And even when I did my initial analysis of this company, the key thing I pointed out was the lack of organic growth. And most of the revenue and customer growth they were seeing was coming from just making acquisitions and adding those new customers, which of course, the only way they would acquire those was by issuing more shares. And now that their share price is depressed, they can't even make the same level of acquisitions as they probably planned they'd be able to just a few months ago before this report got released. So it does seem like there's a lot that could go wrong with Lightspeed, and it just doesn't really instill that much confidence. Now, despite all of this, it's still not actually over for Lightspeed. And I say this partly to qualify my opinion, because maybe the business does end up being successful, and maybe these acquisitions do end up working out despite what seems to be apparent at present time. And my advice to people who found themselves in a tough position if they had bought this company right before that huge drop happened is to just reiterate to yourself why it is you bought it in the first place. Now, keep in mind, this is not financial advice. I'm just giving my personal opinion here on what I would do in that scenario. But if you bought the company initially because you thought it was going to go up a lot, you were told it's going to be the next Shopify, some guy on YouTube told you it's going to 100x, and you had a bunch of FOMO, then maybe just cut your losses and move on. Or what you could do is start researching the business a bit more and decide for yourself if you think it's worth holding on to. Now, keep in mind, doing that is going to be very difficult, because if you already own the business and you have some losses in the business, you're going to be extremely biased as you do your research. And it's going to be hard to look at Lightspeed objectively. So just make sure you're aware of your biases if you plan on doing that. And again, this is just my opinion, but there are thousands of companies out there to choose from when you're deciding what to invest in. Why put your money into a high-risk business like this, which seems to have such an uncertain future? In my opinion, the risk is just not worth the reward. But anyways, guys, that pretty much does it for this video. So thank you so much for sticking around and listening to my thoughts. If you did find this video useful, then please leave a like and subscribe if you're new to the channel and you like this type of content. And I'll see you in the next video.